Federal Reserve slowed down the pace of their interest rate hikes as expected by raising interest rates by 50 basis points in the December meeting, which is lower than the 75 basis point increases done the last few Federal Reserve meetings. Now the interest rate is sitting at a level of 4.5%, which is the highest level since 2007. That's the good news in terms of the Fed slowing down the pace of their interest rate hikes. The bad news is that in the FOMC summary and Jerome Powell's speech, he was a little bit more aggressive and hawkish in his tone, as well as in what's called the dot plot, which is basically where Federal Reserve officials seeing the interest rate being ultimately, after the Federal Reserve is done hiking rates, at a higher level than initially expected at 5.1% compared to the upper 4% range the market expected. Jerome Powell's hawkishness combined with a higher than expected terminal Fed fund rate led the market to sell off a little bit and become a little bit volatile. As of now, the markets are down about 1% across the board. One of the key takeaways in Jerome Powell's speech is that the labor market is still structurally strong and we have a low labor supply, as well as the Federal Reserve is thinking about slowing down the pace of their interest rate hikes, which we saw. However, it seems like they really want to keep it at a higher level for longer and wait and see how that affects inflation and the economy.